Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Rajnish Kumar, former chairman SBI, joining us on the show. Welcome to the show, Rajnish. A pleasure to speak to you as
Thank
well
you.
after a really long time.
Yes.
I hope you're keeping safe and your family and colleagues around you as well.
Thank you.
Thank you. Rajnish, my first question coming to you is uh, the kind of impact that COVID has had on different sectors, on different economies. I think no one has been really spared so far. And the financial system as a whole, which is the crux. How have you seen the impact from March to now in terms of the transition as well?
In March, when started with the lockdown, and April and May, economic activity virtually came to a halt. Then, obviously, there were a lot of concerns. And this is not true for India. Globally, there were a lot of concerns that businesses will go out of business,
Mm,
there will be bankruptcies. In India, the estimates around the stress in the real economy as well as in the financial system. So
mm,
the estimates were varying. Uh, even our own Reserve Bank of India, they had an assessment that NPS in the banking system can go as high to as 12 and a half or 13-14%. Rating agencies, yeah, somebody said 8%, someone said 9%.
mm,
But luckily, I would say for the country, for the financial system, for all of us, you and me, the situation has turned out to be much less scary.
mm,
Just a minute. Let me stop. And why it does so happened? I did some analysis sector by sector,
mm,
and starting from corporates, what happened that in the last 3 years, so much cleanup and deleveraging happened
mm,
as a result of the regulatory actions of Reserve Bank of India, introduction of insolvency code, resolution of stressed assets. So at least there was no backlog. And the recovery after the unlocking happened. So recovery has been fairly good. And
mm,
we are almost back to normal.
mm,
So corporate, there is no rush for the resolutions,
mm.
which was expected. There was a huge demand. There was a clamor that a large scale restructuring will be required, but that has not come to be true either for corporates or for the
Mm.
individual. The liquidity support from Reserve Bank of India, as well as some of the steps taken under Atmanirbhar Bharat package, they were also very helpful. And particularly the guaranteed emergency credit line, which is being operated through SIDB, that has been very helpful for MSME sector.
Mm,
Agriculture, in any case, we had a good year, and agriculture NPA recognition is very different. Mortgages in India, we don't have excesses in terms of very high loan to value or
mm,
very high EMI. So what leaves where some stress is there, that is your unsecured personal credit.
mm,
And that is how the story has turned out to be.
mm,
And of course, this is not the time that we become complacent or we lower the guard
mm,
because everybody has some sustaining power, the corporates or the individuals.
mm,
So 3 months, 4 months, 2 months, one can survive. But if, say, there is a recession and there is a prolonged recession, then the problem can aggravate. And but right now, I would say that the situation is very manageable, And for most of the banks, situation is under control. Whatever I am reading or getting a sense that even all the NBFCs, their collection efficiency has improved. So in a way, things have not turned out to be as bad as was expected, and which is good for everyone.
Absolutely. So I think the actual experience, if you go to see in terms of where the impact is concerned, has been way better than what everyone was expecting at the start of the lockdown. So with this, when you talk about the restructuring schemes, the moratoriums, Rajnish, that the RBI has rolled out at system level, why is the quantum, what is the kind of quantum of loans are you expecting that could be restructured?
Look, for the system, will be difficult for me to predict, but
Mm,
for the State Bank of India, the September
mm,
guidance is that it will not go beyond 2.25%, no, or 2.5%,
mm,
the NPA and the restructuring for the year.
mm,
And I think that is a very sort of a conservative estimate.
mm.
The bank, in fact, may show a better performance than what has been estimated. So if SBI is the proxy and everybody is more or less the same,
Mm.
then what we are looking at is a 2.5% for the NP and the restructure, solely on the basis of what the state bank management is saying.
Right. And then with this, if we see the overall business for the second quarter for all businesses, there was a volume pickup on a substantial basis if we had to compare it to the first quarter of FY21. The overall loan growth for banks was around almost in that range of 9 to 10% on a year-on-year basis. Deposits grew higher at a higher rate of almost 16 to 17%. Now, how would we describe this situation if this continues? Is this situation good, or do you think this could cause trouble for the financial system if the deposit growth remains to be constantly higher versus the overall loan growth?
No, it's never a good situation. You have to balance in the sense that if you have a very high deposit growth and then the credit growth is subdued, then obviously it will have a negative impact on the net interest income of the banks. And the deposit growth obviously has been higher. One is definitely there is more liquidity in the system pushed by the government money, which is flowing into the system on account of direct benefit as well as the liquidity which has been put by Reserve Bank. So that is reflected in high deposit growth. And I think for a period of time, people were not spending as much. Even in the DBT accounts, what again we saw in the State Bank of India, that people have not withdrawn the money which was credited to the
Mm,
account. So I don't know, this may be a very subtle behavioral shift where people want to keep more safety. People are more inclined towards safety and keeping their money into the bank deposits. So that could be one reason. And as far as credit growth is concerned, most of the growth is still coming in the on the retail side. The
mm,
corporate demand for credit has been subdued, and the current growth YOY is about 5.5%. So it
mm,
may go to 7 or 8, and in a very good scenario, it can be 10-12%.
mm,
But we are not going back to those days where the credit growth used to be 20%, 22%, 25%, and it should not be in that way. If we grow at 25%, it is mean we are heading into a disaster.
mm,
And I think the comfort level would be around 8 to 10%.
mm. Right. And then with this, what's happening is if you see the asset quality print that is coming from the financial institutions for the second quarter, it seems to be that they are pretty much in a better position right now. However, what's happening is the anticipation is that the second half of FY21 is something where we could see the asset quality worsen for banks. How are you reading this entire print for the remainder of the year?
Remainder of the year, personally speaking, I don't have much concern. I'm not seeing, as I mentioned, that there is a certain level of NPAs which have been projected by banks. The State Bank of India number I gave you, which was given by the new management when the September earnings call happened. And as I said, again, I am repeating the same thing that the problem can come if you are in a prolonged recession. And the NPAs in corporate book would not be in one quarter then because there is no accumulation. So you won't see that in suddenly in a one quarter there is a spike in NPAs. And if at all the quarter to be washed out is, this will be this quarter, the December quarter. Because the moratorium ended on 5th August, right? And there is no forbearance now available. Hopefully, the Supreme Court would also decide in the matter as quickly as possible. So, December results would need to be washed out, and if at all, whatever is the stress which comes in, whether by way of actual NPA or the demand for restructuring, we should look at the combined number, and 31st December quarter numbers would be relevant. And we don't have a situation like 2017-18, where there were a lot of NPAs accumulated in the system and got recognized during 1 year. And the other thing to be noted is that most of the banks now, in terms of provision coverage ratio, they are very well placed, and legacy accounts, most of the banks are holding very good level of provisions.
Right. So, Rajnish, overall, if we've spoken of the asset quality. Now, another factor that needs to be considered for growth of banks is how the disbursements pan out, how the credit growth pans out in different sections, whether it could be personal loans, it could be, unsecured housing finance, or even business loans. The credit growth is still slow. If credit growth has to pick up, what's happening right now is banks are still playing safe because they're mainly doing top-up loans or with legacy clients where they know the funds are 100% or majority security is there. Whereas new finance is something which is not really picking up, especially to startups, to MSMEs. How do you tackle this situation where if the banks are not really going to lend to as new finance, how do we see that? From where do we see the growth coming back?
As far as MSME is concerned, let me tell you that a lot of changes are happening as far as MSME financing is concerned, and particularly the technology-enabled products or the lending based on machine learning models, where data analytics is being used. So there is a new trend, and State Bank of India, again, I am fully aware that State Bank came out with pre-approved loans for MSME. Then about 2 years ago, the public sector banks came together and launched the product PSB 59 minutes loan. And again, that platform uses a lot of data which is available, GST, income tax returns, credit bureau scores. So when we talk about the lending to MSME, we have to recognize this fact that if there is a data available, if they are part of the GST, if they are part of the supply chains, credit is available. The problem comes when there is lack of information. And if a unit is not part of, say, a GST network, not paying GST, for banks it becomes very difficult to assess their credit worthiness and the credit. And there, that is where the dependence on the informal sector comes in, or when the scheduled commercial banks, they are unable to lend, then there is a market which NBFCs have been able to serve well because their connect with the borrowers are much better. So it is not that money is not available. Money is available. But the real credit growth can come only when there is a huge demand for the investment by the corporate,
Right.
for the working capital or
Mm.
for their fresh capex investment. So unless the capex cycle is revived in a very big way, then the credit growth will be very subtle.
Right. So, what would your view be, especially with regards to corporate credit as a whole is concerned? And do you expect more pain to continue with regards to corporates? Like, for example, something like another future group. Do you see that kind of pain, or do you think things are settling down?
No, again, we are coming to the same question in a different way. That definitely, when the real economy gets impacted, its impact on the financial system comes. And whatever numbers are available in public domain, there is a very clear indication that there is no great rush for any sort of restructuring or uh, the kind of numbers we saw in 2017-18, we are nowhere close to that type of situation. Now, for the fresh investment to happen, there is a huge pipeline for infrastructure. NIP, the numbers are 110 lakh crore in 5 years. So if we are able to spend that kind of money or even 75-80% of it, we can see a very good credit.
Right.
But that is, as of now, it seems not happening. And that is where the more investment is needed.
Correct. And then, Rajnish, with this, another factor that I was looking at in terms of numbers is the check and the auto debit bounce rate of 40% currently, bank collection efficiency of 95% plus. Now, the auto debit failure rate is very high as compared to Feb 20 levels. How do we reconcile these numbers, and what do these numbers actually tell us?
Honestly speaking, I am unable to correlate because every bank has reported the collection efficiency of more than 95%.
Right.
The State Bank reported a collection efficiency of 97 or 98%. So is the check bounce rate is because of insufficient funds or there are other reasons? I think that would need a deeper investigation. Honestly, I don't have a ready answer for this.
Correct. So, I mean, basically, you're saying that we shouldn't actually I mean, there couldn't be any correlation in this, so we can't really make out anything out of these two numbers.
It seems so. We have to rely on the financial statements or the quarterly results, and these are all reviewed. And I like the quality of disclosures also over a period of time has improved. The supervisors have taken a very, I would say, tough stance as far as the recognition of NPS is concerned. All the systems have by and large been automated. So we have to rely more on what is being reflected or being said by the banks or NBFCs who have declared their results or shared the information about the collection efficiency.
Right. And Rajnish, with this, there is, the current liquidity which has come into the system is a big support given to the NBFCs as well by the banks again. Do you think the asset quality cycle of NBFCs will shape differently thanks to the banks this time?
A little bit. There will be some difference because, as I mentioned earlier, that the lending practices of NBFCs and the segment to which they lend is a segment where scheduled commercial banks are not lending. So they are filling a gap. And the performance behavior of this segment could be different. Many of these are self-employed, small businesses. We have to see, but so far, whatever information has come in the public domain and whatever has been the lending to NBFCs, again, there has not been a cause of concern. One or two NBFCs may be in problem or in stress, but we have not seen a large scale problem. Of course, one all the NBFCs after ILFS, they did the course correction, and their dependence on short-term mismatch of borrowings has been reduced. Almost 1.75 trillion rupees was paid. This was a commercial paper and subscribed by the mutual funds. That course correction happened. Reserve Bank of India came out with a new framework for liquidity for NBFCs. And the NBFCs, if any NBFCs today, if any NBFCs go down under, it would be more to do with their own solvency ratio or their quality of their lending portfolio. But liquidity support from Government of India as well as Reserve Bank and the banks, it has come in a very timely manner, and that has helped the NBFC sector to cope up with the current crisis.
Right. And Rajnish, with this, going ahead now, a lot of focus has come in with regards to privatization, with regards to consolidation of PSU banks. How do you see this scenario changing, taking COVID into consideration as well? Do you think that's going to be the way forward and that should be the way forward?
So some consolidation in the public sector banking space has already happened. So now there is no further scope for any mergers, in my view, or further consolidation. Now, as far as the privatization of some of the commercial banks is concerned, I think that is on the agenda of the government. And when will that happen? What preparations are going on? Honestly, I'm not fully aware, but that is definitely on the agenda of the government. And again, the point for consideration has always been that, do we need so many public sector banks? The public sector banks are needed. I think that is what the requirement of the country and the economy is even now, that we have not reached a stage where you can say that we don't need public sector banks. But instead of 26, now the number is down to 12. And if there are a state bank and a few more, 4-5 large public sector banks, then I think that would serve the purpose. And we don't need more than that.
Right. And with this, the idea of the internal working group of the central bank allowing industrial houses to float banks, do you think this is something, and I'm sure, even if they allow, it's not necessary that the RBI is going to go ahead and give out licenses that quickly, because a similar recommendation was made earlier as well. But do you think this is something which is needed?
So this is just a recommendation of the internal working group. And even the governor in his speech after monetary policy has made it, this is not RBI. So that is one. Second is, there is a debate around this, and it can be viewed both ways. But definitely, there is no doubt that corporates into banking, without a very corporates into banking, and without a very strong supervision mechanism around related party transactions and lending. So that is a recipe for disaster. So the question to be asked is our supervisors ready for that kind of responsibility? Are they overstressed or overstressed? We have seen a series of failures. Yes Bank, BMG Bank, Diwan Housing. So what does it indicate? That the supervisory regime was not as strong, which could anticipate and predict trouble at the beginning. So market information was more than what the supervisors had. And giving license to the corporates in such a scenario, I don't think that it's a very good idea. But yes, in the internal working group, they have put in a lot of riders also. One is the amendment in the Banking Regulation Act itself, which gives power to the regulators to supervise not only the banking business, but the entire business of the corporate. So how are we going to operationalize it? First is legislation, second is execution and operationalization. So I think there are a lot of issues, but at the same time, uh, there are very well governed corporate houses who have uh, sound governance uh, structures in place. So why exclude them? That is the other side of the
Mhm.
story. And there are people, or there are the corporates who have sufficiently deep pockets to provide the capital. And we are an economy. We were just talking about that MSME.
Mhm.
More credit is needed. Agriculture, more credit is needed. And in such a scenario, when the economy seems to be starved of credit, then whether someone with deep pockets and want to do the banking business, so why should they be denied the life? But it is all about that, what governance is structured and how much strength and power supervisors have and their capability to recognize the problem at the early stage rather than when it is too late.
Mhm. So Rajnish, when we mention cases like a Yes Bank or a Diwan Housing Finance, do you think this is time to actually conduct a AQR for NBFCs? Do you think we are late, or immediately this is something that should be done?
I don't think that AQR for NBFC is required because they all are mostly still into some sort of a retail bank. MSMEs or maybe some of the NBFCs are active in real estate financing.
Mm,
Unlike the banks, where there were very significant corporate exposures and multiple banking was the norm. And in a multiple banking scenario, AQR become necessary.
mm,
For NBFCs, I don't think that it would serve any useful purpose. There are not, uh, there would not be many cases where multiple banking or from different NBFCs is there. Their ticket sizes is small. NBFCs do not have land 10,000, 20,000,
mm,
30,000.
mm,
So their individual credit size is small. And what is needed is more oversight wherever there is the slightest doubt about the lending practices of any of the NBFCs. Which sector are they operating? What is their corporate governance structure? What is their lending practices? So these are more material, but I don't think that for NBFC any sort of AQR is needed.
right. And overall, from here on, taking all the challenges into consideration, digital as a system is something which has been picking up even for the financial sector as a whole. Uh, Going ahead, do you think consolidation of branches, cutting down of branches is something which is required to save costs, mainly because it's digital banking which is picking up, and rather use those resources somewhere else?
Well, that shift will happen, but India is still is a very
Mm,
big country. The population is very big.
mm,
The consumer segments are very different. And we have a situation where like 60-70% of our population is still very poor. So in such a scenario, I think the need for the branch banking is still there.
mm,
And the nature, the size, what they do, that is definitely undergoing a change.
mm,
Even for digital, my experience with State Bank, where we have built a big franchise around Yono. So the physical presence was very helpful. When something is marketed by say 22,500 branches, the chances of its success are much more than purely digital market. So the
mm.
reach which a physical distribution network provides uh, is very different than what a digital distribution network can do. So it is a balance between the two, and any organization which can strike a balance between these two will be a successful organization. So we need physical, we need digital. But you don't need the branches. The State Bank of India at one point of time, and that was pre-computerization. We had branches where 3,000 people used to work in one branch. Now, if you find more than 50 people in a branch, it is a big branch. So that is the kind of change which is happening. But I think in our country still, the branch network uh, needs to be expanded. And every year our population grows by how much? About 1.5 crore. So that is where this need for physical would remain.
Come up, right? So with COVID now, what should be the way forward according to you for the banking system as a whole? Because pre-COVID also the economy was still in a slowdown. We were not in the best of years that we saw probably at the end of 2017, beginning of 2018. Now, overall from here on, what's your expectation as to what the government or the RBI should do for the banking system as a whole? Any measures that still need to be taken?
Banking system needs a lot of strengthening, and particularly the public sector banks. There is still 60 to 62% of the asset. So the first step has to be that how do we strengthen the public sector banks, or if some of the public sector banks, if there is a plan to open it for the private sector participation, this should be done quickly. A very strong financial system is a must for the economic growth. So there are weaknesses in the financial system. So those RBI and the government need to move in quickly. Whatever steps are required, including augmenting their capital base, improving their corporate governance structures. So there are many measures which can be taken to strengthen the financial system. What the financial system can do is the same thing, improving the corporate governance structure wherever at least the things are in your domain or in management's domain. You can do it. You can't appoint a member on the board of a public sector bank, which is a prerogative of the government of India. So you can't do, if the seats are lying vacant, they are lying vacant. You can't do much about it. But whatever is in your domain about improving the governance or the management quality, that should be done. The second, of course, is adoption of digital. Any bank or any organization which does not have a very clear-cut digital strategy, it will be very difficult for them to compete or survive in the whatever is. But the opportunities are many. New sectors will open up. So in India, there is no dearth of opportunity, given the size of our population, which is growing, given the aspiration, given the growth in income, which is happening, not at the pace at which it should happen. That is a fact. The demand for infrastructure, the demand for healthcare. So wherever you look, you find that there is an opportunity, but you have to get your business models right. And the underwriting models like that, you have to use technology.
Right. And what would you make of the idea of a bad bank? Because that was something where it's constantly being considered. In fact, I think the Indian Bank Association also went ahead, and I think once COVID had just started, put out a recommendation as well, once again for a bad bank. However, it does not seem to be considered yet. What would your view be on it?
My view is that if a bad bank has to be established, there cannot be a better time than this. One, because the provision coverage ratio of the banks is very high. So net book value of the bad assets is very low. It is 15 to 20%, or maybe 25%. So 3 years ago, you could not establish the bad bank because the question would be who will fund it. But in my view, we should consolidate, and that would make the decisions faster. The resolution will be faster. And because the banks have already provided for a large chunk of these loans, So it will be easier to establish. And uh, it has to be different than normal ARC. And the difference has to be the IBA recommended the government ownership for one simple reason, for the capital, because many bad assets would be sold by the public sector banks. Selling it to a government owned entity, but managed by professionals. So I think that was a very ideal structure, but ultimately it is for the policy makers to take a view.
Right. And Rajnish, very lastly, at the last RBI monetary policy, they've kept the rates on hold. However, they've remained slightly dovish right now. Inflation is expected to be higher, at least in the third quarter, and then we are seeing it taper off if you talk about the fourth quarter and then the first half of FY22. Do you think we are acting in the right direction in terms of where interest rates are concerned? And secondly, with regards to growth and inflation, uh, are these sustainable projections?
So one is, of course, right now the priority for everyone in the country, whether it is government or the Reserve Bank, uh, is about reviving the growth in the economy. And that is where the RBI monetary policy, the growth has taken precedence over the concerns around inflation. And inflation also, it is to do more with the supply side constraint. So when it is supply side constraint, so RBI's policy of holding on to the interest rate and the efficiency, I think that is guided by these two factors. And at this point of time, RBI would not like to, disturb or do anything which has an impact on the growth. That is the top priority. And that has shaped the monetary policy of the Reserve Bank so far. And I think directionally, I also believe that first priority has to be to revive the demand in the economy and the growth, and whatever are the supply side constraints, because there were disruptions, there are partial lockdowns. So at times that could also be a factor, but as the economy gets fully opened up, and hopefully, so far the numbers on the COVID-19 side are also, uh, I would say, encouraging in the last 4 or 5 days. So we need to unlock the economy fully, and we need to revive the demand. And that is where I think that RBI was absolutely right in maintaining the interest rate and maintaining the dovish stance.
Absolutely. I think unlocking from here on for everyone is really important and hoping that the numbers remain encouraging and the cases go down. Thank you, Rajnish, so much for joining us on the show. It was a pleasure to have you. Great insights that we've picked up from you for the sector as a whole, for the economy as a whole. Hoping to have you back soon again once things improve from here on. Stay safe, and I hope you enjoyed the conversation as well.
Yes, absolutely. Thank you very much.
Thank you.